You got it.
He will be doing a short presentation on the 2022 tax changes or updates, however.
A little bit of everything. Update. There's still a lot of unknowns as we
Yes.
roll into 2022, but I think it'll be
As of now.
a good jump start on what we can expect going forward. So.
So I will turn it over to you now, Scott.
Okay, thank you, Marlene.
Thank you. If you have questions, you can enter them in the chat, and this will be recorded for future reference and for other people who might want to listen later.
All right, it looks like we've got a few participants jumping on here. I think there's a couple of CPAs too. So hey, I'm just going to open it up to you guys to help me out here. As those in our industry know, things change quickly. There's been so much to keep up on that, you know, if I misspeak or you can add some thoughts or some additional explanation, anything that I talk about, certainly jump in. I'm open to making this kind of a group session here where we can, you know, be open in our conversations, talk about things, and really just try to get something out of this. So as Marlene mentioned, my name is Scott Martin. I'm with SSC CPAs and Advisors. I'm a shareholder here in our Shawnee office, and I am a CPA, and that stands for close personal attention and not certified pain in the you know what. That's what my wife likes to refer to me as, but I say close personal attention. And I have to admit that that is not, I didn't come up with that slogan. That was actually credit to Gary Summers, who was our founding managing shareholder of the firm, but he has since retired, and I've stolen his slogans. So there you go. So what I hope to do here in the next 30 minutes to an hour is kind of the past, present, future theme. I'm just going to rehash a little bit of what we've all been through, you know, 2020, March, COVID, up through today. Talk a little bit about changes that are out there for 2021 and what we need to do now to plan for that tax season, which of course will be in the spring of 2022. And then a little bit about what we might expect down the road. Still a lot of unknowns about where things are going. There's been a lot of proposals, a lot of talk. So at this point, we can speculate based on those points and, you know, talk about it. So I think one thing that all of us are a bit aware of is that taxes certainly seem to be going up in the future. I mean, that's all the proposals that we're seeing, so we can talk a little bit about that. So I'm going to share my screen here, and I'm going to toggle between a couple of different formats here in this presentation. So let me just do that real quick. Okay, so as I said, my name is Scott Martin with SSC. I've got my contact information up there, phone number, email address. Yeah, certainly feel free to take a picture of this. I can share this with Marlene, and she can send out the presentation information. I'm certainly available to answer emails or any questions, follow up that you might have, and see if I can help you. As I mentioned, you know, kind of what we're looking at here is 2021 mostly, and what changes are coming for the tax season. Talk a little bit about what might be down the road. Again, that past, present, future theme. So let's just dive back into the past a little bit. Back to March 2020. Of course, we had COVID and the crisis that everybody went through. But I wanted to give you a sense, and some of you know this, all of the bills, the acts, just the craziness that was going on in our world, not just with respect to COVID, and certainly how that impacted families and you know, just the change that we had to face, but more so from our industry perspective a little bit, and what it was like for us CPAs. I mean, it was a crazy, crazy time. I'm sure the 2 or 3 other accountants on here can attest to that. Just look at all these bills that passed. This may not be all inclusive. I'm sure there's some that are missing here, but we had, you know, a lot of this is COVID relief stuff that came out and we all had to deal with during tax season. We had the Families First Coronavirus Response Act. We had the CARES Act. That was the first act that included the first stimulus payment that we all received, the $1,200, and that was in March of 2020. Of course, we had the Paycheck Protection Program loans. You know, we had first loan. We had that loan being extended, more money being put out there, and then we had PPP loan number 2 come about as well. We had a couple more acts that included a second round of stimulus payments, a third act that included a third round of stimulus payments. And, you know, us CPAs, we're all trying to deal with this during our busiest time of the year, right? Which was the tax season 2020, working on the 19 stuff. So, you know, some of the things that came about from all of those acts, I mentioned the 3 economic impact payments. We had changes to the child tax credits. We had changes to RMDs in 2020, if you recall, people that were in the age group that required them to take a minimum distribution from retirement accounts did not have to. That was one of the COVID relief items for those that were in retirement. There were also COVID-related withdrawals from retirement accounts, where if somebody needed to get money out of retirement and had a COVID-related issue, they could withdraw from their retirement accounts up to $100,000. And then there's some rules about when that would need to be repaid and so forth. Again, I mentioned the PPP loans, round 1, extension of funds, round 2. We had economic injury disaster loans. We had state and local grants. We had forgiveness of 6 months of principal and interest payments on SBA loans. Of course, unemployment compensation and the taxability of that, you know, $10,200 of that was tax exempt if you were within a certain income range. ERTC, which was the employer retention tax credit, and there were other payroll tax related deferrals for businesses. And then, of course, you know, our tax season was extended. The 2020 tax season was extended to July 15th. 2021's tax season was extended to May 17th, and really for good reason. I mean, I was probably in the group that wanted to see the 2021 tax season extended longer. These are just a few of the things. There's just been so many changes. Our world was really thrown upside down from a tax and financial perspective. And, you know, we continue to dig in and figure this thing out. I mean, there's just continuous changes coming down the pipe too. So don't want to get too deep into the past, but just, you know, kind of set the tone for where we're at today. I think it's a good reminder to think about all these things that we had to go through in the past 2 tax seasons. A little bit of humor, just to kind of illustrate how I felt during the past 2 tax seasons. My 2 kids would tell you that this is a dad joke. And that's about the best jokes that I can come up with is dad jokes. So, but this is truly kind of how I felt. I'm sure the other accountants on the call here felt this way, and you know, honestly still feel this way. So it's just tired, but fun too. This is where we get the opportunity to consult with our clients, help them, and that's really what this is all about, right? It's helping people save taxes, get through these things, make decisions that are in the best interest of their family and their finances. Real quick, 2022 tax season, which will be for 2021, the IRS has put a page out there, their recommendations of how you can make tax filing season easier for yourself. And this is really, there's nothing magical here, but I think it's a good reminder to just highlight these things, right? I mean, the most important thing in preparing to file your tax return this upcoming spring for 2021 is to be organized, right? You know, whether that's getting your file ready, 2021 taxes, you're putting all your documents together, keeping things neat and tidy certainly will help you. It'll help us. It prevents mistakes happening on tax returns. It can prevent future IRS notices. Just being organized from the get-go is extremely important. Certainly, we send out tax organizers. I look at it as a tool, a checklist, just to do just that, to help you stay organized, keep track of things, know what you had last year that you might be missing this year, etc. Again, I mentioned changes that are still coming down the pike. Obviously, this year we had the third stimulus payment for $1,400. Everyone is going to have to keep track of that and let us know as tax practitioners if you received that payment. There should be a letter coming from the IRS to you that indicates that you did or did not receive that. Well, actually, I think it's only if you did and how much that stimulus payment was. Child tax credits. There's advanced child tax credits going on. There's been an increase in child tax credits. Again, there should be a letter coming from the IRS indicating whether or not you've received some of those advanced child tax credits. It'll be extremely important for us as CPAs to get our hands on this information because there are reconciliations on the tax return that we need, that may actually be to your better. You may get some rebates for these things if you hadn't received them or didn't receive what you should have been. So, keeping those letters with your other tax documents is going to be very important. One of the things that the IRS recommends is that taxpayers create an online account for themselves. And so what I've done here is just took a snippet of the IRS webpage where you can actually create your own online account. And there are so many tax notices coming out right now with respect to stimulus payments and rebates that maybe were incorrect on tax returns. And this page here is going to be your best friend. So if you did not receive one of those letters from the IRS telling you how much your third stimulus payment was, or you don't know, you didn't keep track of your advanced child tax credits, please go online, create an account. You will be able to see those things. You'll be able to see how much you received. You'll be able to see how much tax you owe, payments that you've made, etc. This could be very handy for you, for us, and certainly if a tax notice is received by you. Lastly, the IRS says now is a good time to check tax withholding on your pay stubs. Especially if you have life-changing events, right? If you have a kid or you change jobs or you retire, got divorced, got married, those are good times to check your withholding, right? We've only got 2 months left in the year to make changes. So if there has been a life-changing event and or, maybe the prior year tax return, you didn't have enough withheld and you owe tax, maybe you had too much withheld and you want to try to make some changes here in the last couple months to minimize, a large tax bill come April, now's the time to look at those things. Estimated payments too. We're already three quarters in this year on estimated tax payments. If you have to make those, we have one left on the 18th of January 2022. So again, just think about those things and if you need to get that last estimated tax payment in. Real quickly, let's look at the tax brackets for 2021. You'll notice that the top marginal tax bracket for 2021 is still 37%. So that's unchanged from 2020. What did change, just minor inflation adjustments. So the amount of taxable income thresholds that you see there, those adjust each year slightly for inflation. So no changes in the 2020 ordinary income tax brackets for individuals. You can see the long-term capital gains rates. Those are unchanged as well. We still have a 0% rate if you're in a low taxable income, 15%, 20% for the high earners. Okay, again, no changes in those rates for 2021. Changes in annual deferrals for retirement accounts. You'll see in 2020 and 2021 that there are no changes in these. So the amount that you can put into a simple IRA for 2020 or for 2021, I should say, is the exact same amount it was in 2020. That is true for the 401k, the traditional IRA, the Roth IRA. Really, the only things that are changing here, again, are the adjusted gross income phase out limitations. Okay, so as you know, on some of these retirement accounts, if you make too much money or you participate in another retirement account, you may be limited on your ability to contribute to these. So they've increased some of those thresholds, but again, the dollar amount that you can contribute to those has not changed. Okay, so I'm going to toggle here to another screen. Give me just a second here. Marlene, can you see the screen that says year-end tax planning special report? Okay, perfect. Okay, so we use Checkpoint as a firm. It's our research tool, and they have put together this, it's a 36-page tax planning report for 2021. We're not going to go through word by word every single page here. I've highlighted a few things, and I just thought it would be easier to share this, kind of go through it together as a group rather than regurgitate it and put it into PowerPoint. So here we go. So generally, when it comes to 2021 versus 2020, you'll see that I have highlighted here that there really aren't a lot of major tax changes, okay? So a lot of the changes that were made with the Tax Cuts and Jobs Act in 2017 still remain in play, okay? So that means lower income tax rates, as you saw on the previous slide, you know, we're still at the top bracket of 37% in that graduated rate system. We still have a larger increased standard deduction. We still have limits on itemized deductions, you know, sales tax and state income tax being the primary one there. We still have an elimination of personal exemptions. We have increases in child tax credits. That is one thing that has changed, and we'll talk about that here in just a couple minutes. We, you know, lessened alternative minimum tax, no AMT for corporate taxpayers. Corporate tax reduction rate is still in place. So for C Corps, you know, we're at that flat 21% tax rate still for 2021. And of course, other limits and things, we still have the qualified business income deduction for flow-through entities. So all in all, a lot of these changes are just, you know, pretty minor when we're talking about 20 to 2021. I think the big question is, what are we going to see going forward? And there's still quite a bit of unknown there. So, you know, I think as we're planning this tax season compared to last year, we're still going to look at kind of the basic set of rules. There are a few things that I'll highlight here that we'll go through just to give you a better idea of what did change in 2021. This little next section I've highlighted here generally follows what we all have tried to do each and every tax season, right? It's the time-tested approach, as it says, of deferring income and accelerating deductions, right? At this time of year, every year, if you're paying attention to taxes, you are trying to defer income, push it down the road, push it into next year, and accelerate expenses if you can. And then you try to do that every year, right? You're trying to kick the can down the road. You're trying to minimize tax as much as you can. I think you'll see throughout this presentation, though, that this may be a year that you consider doing the opposite. So if we expect tax rates to go up, or, you know, maybe I guess that coupled with changes in income, maybe you'll be in a higher income bracket the next year. This may be a year where you actually go against the grain and you try to get income into this year while we're still in these lower tax rates, or you try to push deductions in the next year. So you kind of have to rethink this a little bit from the norm, which is generally push everything down the road if possible. We'll see some examples of where that might come into play here. Okay, so I know this is a small business webinar, but everyone individually also files a tax return. So I wanted to give you an overview of individual and some business things to think about. What's new for individuals in 2021? That first section that I've highlighted there, the home office. Obviously with COVID, so many people working from home, this is a big question that I think a lot of people ask is, hey, I'm working from home now. Can I take a home office deduction? And I'm going to toggle back here again real quick to a little slide just to throw a little bit of humor into my presentation so that I don't bore you guys all to death. Let's see here. Okay, so I have a home office. Can I deduct trips to the kitchen and bathroom? The answer to that would be no, obviously. But as I said, a lot of people are working from home now. And so that question is going to come up. I will say this, that if you are a W-2 employee, one of the changes that was made back in 2017 was taking away what is called an unreimbursed employee business expense. It was an itemized deduction. And if you were a W-2 employee that worked from home, you may get some benefit out of claiming a home office deduction as a W-2 employee by way of using an unreimbursed employee business expense. That is no longer true. That deduction was taken away, as I mentioned. So if you're working from home and you're receiving a paycheck from an employer, unfortunately, the home office expense is kind of nil for you. What you might be able to do is you might be able to ask your employer to reimburse you for certain expenses of working from home. That's really the best approach that you've got, is to see if they will take on some of those expenses, reimburse you, would not be taxable income to you, and you know, you've kind of got the best of both worlds there. If you obviously run a business as a sole proprietor, Schedule C, partnership, yes, home office deduction is something that you should be paying attention to if you've been working from home. There's a couple different ways to calculate that. I'm not going to go into too much detail on it, but just make sure you jot that down as something that you want to look into and make sure you're taking advantage of that tax deduction. Let's see here. Pending legislation. This is looking a little bit into the future, and we've kind of talked about this. You know, I think generally we can expect an increase in tax rates. Now, everything we've heard is that this increase will be targeted to high income earners. There's talk of eliminating the $10,000 limit on state and local income taxes as part of your itemized deductions. In fact, I think there's a proposal in the Build Back Better program right now that would actually increase that amount quite a bit. So that would be a significant change if we're able to add more taxes to our itemized deductions, especially with that doubled standard deduction. We might, if that comes to going forward, now not for 2021, but if that comes to going forward for 2022, you know, then I think we're looking at maybe more people itemizing again, as opposed to just going standard deduction. There's been talk of an increase on the C corporate tax rate. Currently that's at 21%. I've heard anywhere from 25, 26 up to 28% flat on that. A couple other things there that we'll dive into a little bit more here going forward. Let's look at filing status and dependents. Again, one of the big changes this year is the child tax credit. If you recall, that credit was $2,000 for children under the age of 17 in 2020, I believe. 2021, they're increasing that to $3,000 per child, including 17-year-olds, not 18, but 17, and increasing it to $3,600 for children under 6. Okay, and this is where those advanced tax payments have been coming into play. The IRS has been providing advanced child tax credits to people they believe qualify. This wasn't something that you opted in. You had to actually opt out of this program. And they were going to pay those for that additional $1,600 bucks, the $3,600 less the $2,000 if you had a kid under 6, or the $1,000. So it's just looking at the change, the increase there in those child tax credits. It's important to know that these do phase out, these increases. The phase out does not apply, though, to the first $2,000, which is what the child tax credit was in 2020. Filing status, you know, they're just reminding us that, hey, if you get married on December 31st, guess what? You're married for the entire year. that, you know, that could present a planning opportunity. I don't know if you have the ability to change the date of a wedding that you've had set in stone for a while, but you know, you sometimes hear the term marriage penalty. If you've got two high income earners, you get married on the last day of the year, you might actually be in a more taxed position than you have been as single. So that would be something to maybe look at and change that wedding date to January 1st of the following year if you can. Let's see here. Dependents, if you recall, Tax Cuts and Job Act of 2017 took away the dependency exemption. So that is still 0 for 2021, unchanged there. So, you know, I guess, again, going back to how can we plan for 2021? We're in an unusual spot. I mentioned that if tax rates do increase in 2022, our train of thought may be going against the grain, right? I had said previously, defer income, accelerate deductions, reduce taxes. That's the general theme. But if we know tax rates are going to go up and it affects us, you know, a lot of these are for high income earners, then we may be going the other way. We may be trying to increase income this year and defer deductions to the following year. So that's really what this is saying is what are ways that we can increase and decrease our adjusted gross income, depending on which way we want to go here. And so let's see here. You know, this just says that, again, pretty much what I said, that if tax rates rise, we may want to defer income to 2022 if we can. This gives a couple of examples of who should increase adjusted gross income. So generally, if a taxpayer expects to be taxed at a higher rate next year, you might look at some of these ideas, or these are types of people that should try to increase adjusted gross income in the current year, right? So if a taxpayer is graduating from school, moving into the paid workforce, head of household or surviving spouse status ends after this year, right? If you're head of household or surviving spouse status in 2021, it might be better for you to get income in 2021. Accelerate income, pay a tax on a lower rate this year, but taking advantage of that status when 2022 would change. We talked about taxpayers getting married, et cetera there. Who should decrease AGI? So a taxpayer who expects to be subject to the same or lower tax rate next year should consider deferring income recognition. Okay. So an example of somebody there would be somebody might actually change filing status next year. Somebody becomes eligible for head of household status next year, or the taxpayer expects to have a lower income. They change jobs, they retire. So I think the point here is that every situation is different. Obviously, everybody's tax return is different. There's so many things that can happen. It's really important for you to be talking to your CPA, and know what those nuances are so that you can plan. And this is the time of the year to do that. Let's see here. Capital gains and losses. I had shown earlier the capital gains rates, the long-term rates, they're unchanged for 2021. We talked a little bit about what that might look like going forward. There's proposed legislation that might increase, but again, I think the plan is for those increases to happen to really high income earners, or somebody that maybe has a significant sale and produces a large amount of capital gains. So I don't know that a lot of us will have to worry about that. If you do, it's a good problem to have. So good for you. But if you do have to worry about that, if you think you might be in a 25% long-term capital gain rate going forward, then there's steps that you can do now, right? You can try to sell at gains now, pay tax at a lower 15 or 20% rate now. So again, that's where we're going against the grain here, trying to get income into 2021 as opposed to 2022, possibly. Again, some of this just summarizes what I just said. Of course, if you've got a lot of capital gains and you're really trying to minimize taxes, I think we all know that you can harvest some losses, try to sell things at a loss if you have them, reduce some of those capital gains, things like that. One point that I'll make out too is that in the slide showing long-term capital gains rates, there was a section where capital gains can actually be taxed at 0 rate too if you're in the lowest taxable income bracket. So I think it's important to, if you're in that zone, pay attention to what your gains are. You might not want to take some losses. You might want to go ahead and recognize gains and pay 0% tax on them. I had a specific instance just a week or so ago where somebody was actually looking at converting traditional IRA monies into a Roth. And we started to dig in a little bit and started to do some projections for this person. And this person was actually in retirement. They had not reached the 72-year-old RMD age yet. So they're trying to see if can we get some money out of traditional into a Roth before I have to start taking minimum distributions. And as we started to dig into the projection, it was interesting because, our initial thought was, hey, how much can we convert before it pushes us from a 12% tax rate to the 22% tax rate, right? We want to stay, we want the converted income to stay the lowest rate possible. And so, we had estimated, hey, we think we can convert $14,000 before you're pushed into that next 22% tax bracket. But in doing the projection, what we realized is that by projecting a conversion of $14,000 from traditional IRA to Roth, what that did is it actually triggered some of the capital gains that they're expecting to be taxable instead of at that 0% rate. And so, looking at the overall effective tax rate on those converted dollars, instead of being 12%, it was actually 27%. So just an interesting thing. And then, you've got decisions. Okay, well, maybe this isn't as good. Let's not do the conversion because we want to keep that 0% rate on all these capital gains. So just a lot of things to think about with respect to capital gains and the brackets you're in and how those are taxed, and, and then putting other things in there with it. I'm not going to go into too much on this. I just want to make a general comment on passive activities. I get a lot of questions about rental activities. A lot of people think, hey, I'm going to buy a rental house. I'm going to cash flow it, but I'm going to get to write off the depreciation, maybe even show a loss for tax purposes, and use that loss to offset other income. And passive activity limitations generally are a big holdup there, especially if you have a pretty decent sized income. By their nature, or I guess in general, the IRS considers rental activities to be passive. Okay, what that means in a nutshell is that those losses, if they're generated from a tax perspective, can only be used if you have other passive income. So interest income, dividend income, other investment type of income. If you don't have other passive income to offset a rental passive loss, and your income is at a higher rate, guess what? That loss is suspended under the passive activity rules. It's not lost, it's suspended and carried forward indefinitely until either you have passive income in the future or you dispose of that passive activity and realize some passive income from sale. So I just want to throw that out there that rental activities don't always save you taxes immediately like a lot of people think they will. A couple things here on standard and itemized deductions. The medical expense floor of 7.5% of AGI is still there, still made permanent. That's a tough one to hit for a lot of people. You may have noticed in 2020 that if you contributed $300 or more in cash, but did not itemize, that you did get an above the line deduction for charitable donations of $300. That number is going to increase to $600 for a joint federal return in 2021. So if you know that you won't be an itemized deduction filer, yet you do, contribute to charities and you do so in cash, you will get that $600 above the line deduction. Educator expenses are still around. Let's see here. In general, when people ask, what are the best ways for me to save taxes? My general response is contribute as much as you possibly can to retirement contributions if you're trying to save taxes, and or participate in a health savings account. So a high deductible health plan where you can put in pre-tax dollars into an HSA. Those are two really good ways to save taxes if that's what you're trying to do. This right here just talks about HSAs a little bit and the limits: $7,200 for a family, $3,600 for an individual. Again, you have to be in a high deductible health plan. But again, a good pre-tax mechanism to save taxes, but also you're putting money aside for health related costs, right? If you use that money to pay for health care items, any gains that you have on that income is not taxable. We talked about state and local taxes. Currently, there's a $10,000 cap on those for itemized deductions. I highlighted an illustration over here. I think it's pretty good. This talks about, Gabby contributed more than half of her mother's support during the tax year. She has her own medical expenses that'll exceed 7.5% floor. But her mother incurs substantial medical expenses, and the mom's not going to receive any tax benefit by paying those. Gabby should consider paying the medical bills directly before year end on behalf of her mother, and she's very likely could include those on her own personal tax return. So she's already hit the floor, paying for a mother that wouldn't get them, increase that itemized deduction. Not going to go too much into the education stuff. 529 plans, those you can continue to put money into a 529 plan if you're the owner. Actually, you don't have to be the owner in Kansas. I think you do in Missouri. And you get a state tax deduction up to a certain amount that you put into the 529 plan. Of course, the great thing about those, if they're used for education down the road, any earnings on those are tax exempt. Some changes to the earned income tax credit. I did not know this, but I guess taxpayers can elect to substitute their earned income for 2019 in calculating an earned income tax credit if that earned income was more than it was in 2021. It might get you a higher earned income tax credit by using a higher income in 19. We talked a little bit about retirement changes that we've experienced in the last couple of years. RMDs, as I mentioned, were suspended for 2020. This was not extended into 2021. So if you've hit that age limit, or you had hit that age limit, you got to take your required minimum distributions from retirement accounts again this year. So be sure not to miss that. One little wrinkle in that is if you turn the age, which is 72 now, of requiring a minimum distribution, you may not need to take that distribution until April 1st of next year. So again, I think a tax planning opportunity if you hit that age this year as to what year you might take that first RMD. Of course, if you push it out to next year, I think you're going to have 2 RMDs hit in 1 year. But again, looking at what your income looks like, what tax bracket you're going to fall in, of course, as we've talked about quite a few times already, what the tax rates will look like going forward, all those things will come into play. But a wrinkle there that you might be able to take advantage of. Gift tax exclusion, $15,000, going to increase to $16,000 in 2022. There's quite a few proposals and speculation about estate and gift taxes going forward into 2022 as well. That could be a whole nother conversation outside of this little update here. So we won't get too deep into that. Again, this kind of highlights a little bit of what I just talked about. Again, this is all speculation, I believe, but currently the estate tax lifetime exclusion is $11.7 million per person, 23 million per couple. They've talked about reducing that significantly in the future, which would have a lot of implications on trusts and people's estate plans and planning that they would need to do. Okay, let's dive into businesses a little bit. Again, not a whole lot has changed from 2020 to 2021. You know, we still have qualified business income deductions for flow-through entities, partnerships, sole proprietorships, S corps. So really no change there. The only thing that may have changed is when those deductions phase out or start to phase out, depending on income levels. Certain types of businesses that we call specified service businesses, us accountants being one of them, you know, could have that that deduction reduced significantly if we're in a high income tax bracket. But again, for the most part, that deduction is still here. Again, you know, I've highlighted cash versus accrual. This was a change that actually came out a couple of years ago as well. I don't, you know, I think most people around here and maybe in this call are probably using a cash method. If you're not, there may be a good reason that you're using an accrual method. Maybe you have inventory and things that require you to be on that type of method. But that is one of the best things that you can look at from a business perspective is the type of method that you're filing your tax return based on. So as you know, in a cash basis method, you're going to pay tax and recognize income when cash is received, and you'll recognize deductions when cash is paid. So pretty simple, different from what you might think of as a normal financial statement, right? On an accrual basis, where you're recognizing income when it's earned as opposed to when cash is received. But this is a great tax planning tool for businesses. I think it gives you a little bit of flexibility as to when you want to receive cash or when you want to pay cash out. Again, talking about what your income looks like this year as opposed to next year, whether you want to follow the traditional approach of deferring income and speeding up deductions, or if you think tax rates will rise and you'll be one of the victims of that, you know, doing the opposite here. But you can do things on as a cash basis taxpayer, right? You can maybe delay billings and delay. I guess if you delay billings, you would hopefully delay collection of receipt on those. You might be able to prepay certain expenses. Some of them, even if they have an 8-month, 12-month carry out, so like prepaid insurance on a recurring item exception type of thing, you might be able to get some deduction if you prepay certain months interest in the year. Again, I think the point there is that looking at how you file your taxes and what method you use could give you some flexibility as to which year you want to report income in or which year you want to take deductions in. Most people should be on a cash basis, right? If your average gross receipts for your business is less than $26 million and you're not required to use the accrual method, you know, you probably should be looking at whether a cash basis method makes sense for you. Depreciation 179 and bonus depreciation, again, back in 2017, Tax Cuts and Jobs Act significantly allowed us to take advantage of these, and those things are still around. So if you bought tangible personal property, or if you need to buy things that make business sense, vehicles, things like that, although I will say there can be limits on vehicle deductions. But if you're buying computer equipment or furniture or machinery and equipment, chances are you're going to be able to write that off immediately if you'd like to do so. Again, tax planning, you can have options as to whether you take that all at once or not. So, you know, it does require probably a little bit more in-depth look. But if your goal is to reduce taxes and for business purposes, you need to buy something, you know, it makes sense to buy it before year end, make sure it's up and running in service, and you can write off most likely 100% of that purchase that you've just acquired. We talked about QBI a little bit. Again, we talked about changes in thresholds and when those come into play and how much of that QBI flow through deduction you'd be able to get. Again, year-end strategies. It's really about looking at where you expect to be at the end of the year, right? If for that qualified business income deduction, if you're reaching a threshold that might start to limit that, you might look at either speeding up income or actually deferring it, reducing that limit. So there's some planning opportunities there as you approach year end here that try to take advantage of that deduction as best you can. Not going to go too much into net operating losses here. I guess looking into the future, one of the things that have been talked about, which would be quite a significant change here, is the flow-through income from partnerships and S corporations. They're talking about implementing what has been called the net investment income tax. It's a 3.8% tax on passive income. If you are in a high income earning level, they're talking about making that 3.8% net investment income tax applicable to potential flow-through income from a partnership or an S corporation that was not paid by W-2 wage. So again, I just think something to pay attention to and continue to monitor and see if that's something that might affect you. And if it does, there might not be a whole lot to do about it, but something that we need to pay attention to, I guess, for future planning opportunities. Just another quick cartoon here. You're the father of 2 tax exemptions. Actually, this is an old cartoon. If you recall earlier, I said the dependency exemptions are no longer, but hey, you'd get higher child tax credits. So having kids is good for accountants, right? So we talked a lot about 2021 and not a lot of changes, but a few little things here and there. I think, as I've said several times throughout this presentation, is what is going to happen in 2022 and beyond. And as I sit here today, a lot of speculation, a lot of proposals, a lot of things put out there, but nothing, to my knowledge, has been written in the law. Nothing is concrete. But just wanted to give you an idea of what the tax bracket system might look like based on some of that speculation. So you can see here, 2021 on the left side, 37% top tax rate. There's been talk in 2022 that those brackets would remain, or the rates, I should say, would remain unchanged for those in the lower brackets. But you can see as you start to increase your income that we're going back to the highest marginal tax rate that we've had, in the past at 39.6%. And that's at $450K as opposed to $628,000 in 2021. So just an idea of what that might look like based on some of the speculation that's out there. Again, some of the other things that you may have heard and seen: raising long-term capital gains rates for households making over $1 million. Probably not going to affect a lot of us. We talked about 39.6% effective rate, again, for the top income earners. Had mentioned previously some of the estate planning changes that could be coming. One of those things that's been talked about is ending a step up in basis at the date of death. So just, in a nutshell, if somebody passes away and you inherit property, under today's rules, you get a step up in basis to the fair market value of that property based on the date of death. They've talked about eliminating that or reducing it. Here it says eliminating it for people that are, again, making significant incomes. Possibly taxing appreciated property at a time of gift. So that would be something different. So just a lot of things, I guess, to think about. Corporate tax rates I mentioned earlier, 21 to 28%. I've heard 25, 26%. There's been a lot of debate as you know here in the last couple of years, C Corp versus S Corp. Now that C Corps are a flat 21% rate, is it better to be a C Corp or an S Corp? Again, it requires a lot of planning and thought into that. But with that reduction of the C corporate tax rate has brought about a lot of discussion on whether it makes sense to be a C Corp or an S Corp. So I am just going to end with this little cartoon here. I'd like the short form instead, and the IRS person is saying that is the short form. So again, a pretty high level presentation here. There's so much out there. There continues to be so many changes. I think, as I've said numerous times, just talk to your CPA, plan, be proactive, be prepared for 2022. And you know, if you do that, then you can take advantage of a lot of these changes and hopefully pay the least amount of tax that you are allowed to. And that's all I've got. I'll open it up to questions, comments. Anybody want to add some thoughts, expand on anything? Again, if somebody has questions or wants to shoot an email or phone call to me, I'm happy to take those.
Hey, Scott, can you show us your contact information again one more time on
Yeah.
that slide? You may need to share your screen, just so you know.
Oh, I do.
And then I'm guessing SS&C, they offer both business and individual tax filing options if someone needed help or assistance in filing their
Correct.
tax.
Yeah, we're full service accounting firm, taxes, tax planning, accounting services, payroll, bookkeeping, CFO type work, audit. We do a test work as well.
Are there any questions from anyone? No. Thank you, Scott. And again, we will post this on YouTube and share the link so other people will be able to hear what
Okay.
is going on.
All right. Thank you, guys.
Thank you.
Have a good day. Bye.
You too.